The Income Tax Act makes no mention regarding the distinction between revenue receipts and capital receipts. Similarly, it has not mentioned any distinction between capital expenditure and revenue expenditure, or between capital loss or revenue loss. However, a distinction between these terms is of great importance for the purposes of income tax. A revenue receipt is taxable as income unless it is expressly exempt under the Act. A capital receipt is generally exempt unless it is expressly made taxable, right? Income tax normally allows revenue expenditure as a deduction while computing income and not capital expenditure. Similarly, it allows a revenue loss but not capital loss in computing total income. Okay, very simple, right? A revenue receipt is taxable as income, right? What does that mean? Very simple, right? Let's cut out the jargon. What is a revenue receipt? You sell something, taxable as income. What do you sell? That's important, right? If you sell a capital asset, basically, right, that is generally exempt unless it is made taxable expressly. Okay, capital gains tax. That's where capital gains tax comes in. When you sell a capital asset, basically, when you sell a capital asset, you pay capital gains tax on it. Okay, that's the head it comes under. Okay, not any other head, right? So, revenue receipt, taxable as income, capital receipt generally exempt, right? But when you sell a capital asset, it comes under capital gains. Income tax normally allows revenue expenditure as a deduction while computing income and not capital expenditure. Okay, so this is important now. We need to understand what constitutes capital expenditure and what constitutes revenue expenditure. If you're a lawyer, okay, this is how your skills will be tested in a court of law, right? The case would have, let's say, reached the high court stage. It has gone through all the appellate process. It's gone through the, income tax appellate tribunal. It's come to the high court. You're an expert, right, in tax law. Okay, where is your skill going to, how is your skill going to be tested here? Your skill is going to be tested here, right, on how you can show whether a particular expenditure is capital expenditure or revenue expenditure. Okay, this is a skill that you possess as a lawyer. Like I said, words are our stock in trade. Words are what we make a living out of, right, basically, right? That's something the auditors and the chartered accountants can't do. They can look, they can calculate, they can work with numbers, they can work with the act, right? But when it comes to a code of law, it's you, the lawyer, right? Basically, so you have to convince the judge that, no, Your Honor, this is not a capital expenditure, it's a revenue expenditure, or no, Your Honor, this is a capital expenditure, this is a revenue expenditure, not a capital expenditure. You get the point, right? Basically, so it's very important for you to conceptually understand what is capital expenditure and what is revenue expenditure. Okay, now there is a working test that has been laid out, right, by the courts, by the Supreme Court no less, in Assam Bengal Cement versus CIT. Okay, a working test for determining the nature of expenditure. So you've been hired by an assessee. The assessee says, I want you to show that this is revenue expenditure. I want you to argue before the court that this is a revenue expenditure and it is deductible. I want you to essentially disprove, I want you to take on the revenues case that no, this is a capital expenditure and not deductible, basically. Okay, and if you're a lawyer for these big MNCs, right, the distinction between a capital expenditure and a revenue expenditure could be, the difference between a few crores, basically, right? You could be saving your client crores and crores of rupees, and if you're going to be in a position to save your client crores of rupees, he might just give you a crore or two himself, right? So basically, it's so important that you understand the difference between capital expenditure and revenue expenditure. Okay, so what's the working test? In cases where the expenditure is made for the initial outlay or for the extension of a business or a substantial replacement of the equipment, there is no doubt that it is capital expenditure. A capital asset of the business is either acquired or extended or substantially replaced, and that outlay, whatever be its source, whether it is drawn from the capital or the income of the concern, is certainly in the nature of capital expenditure. This is the Supreme Court in Assam Bengal Cement versus CIT. The question, however, arises, right, for consideration, where expenditure is incurred while the business is going on and is not incurred either for the extension of the business or for the substantial replacement of its equipment. Okay, now this is the crux of the test, right? Listen carefully. Such expenditure can be looked at either from the point of view of what is acquired, or from the point of view of what is the source from which the expenditure is incurred. If the expenditure is made for acquiring or bringing into existence an asset or advantage for the enduring benefit of the business, it is properly attributable to capital and is of the nature of capital expenditure. If on the other hand, it is made for the purpose of bringing into existence any such asset or advantage, but for running the business or working it with a view to produce profits, it is a revenue expenditure. Okay, let me give you, right, a simple illustration. Okay, right, you pay a listing fee to a recognized stock exchange. Okay, you pay a listing fee, right? Let us say you're a publicly traded company, right, on the Bombay Stock Exchange. Okay, you pay a listing fee, right, for the first time your stocks are listed on the stock exchange. Okay, an annual listing fee is also paid. The annual listing fee paid to any recognized stock exchange is revenue expenditure. However, initial listing fee is not allowed as a deduction since it is treated as capital expenditure. Beautiful, isn't it? I mean, this is what makes me love tax law, right? Look at how fine the distinction is. When you list your company's stock for the very first time, you pay a listing fee. Okay, so let us say, right, your Facebook, right, and you want your stock traded on the Bombay Stock Exchange. Okay, so Facebook has made an IPO in the past, etc. Right, let us say Facebook wants to be traded on the Bombay Stock Exchange, and Facebook says, you know what we're going to do? We're actually going to get ourselves listed. So the year is 2013, let us say, April 1st, 2013, they pay a listing fee, right, and then every year they keep renewing it and they keep paying an annual listing fee. That initial listing fee paid by the company on April 1st, 2013, right, is not allowed as a deduction since it is treated as capital expenditure. But the annual listing fee is treated as revenue expenditure. So look at how fine the distinction is, right? So you have to apply the working test, right? You have to apply the working test basically, right? Right? The test of enduring benefit, basically. That's what it's called, okay? Right? The aim and object of the expenditure will determine the character of the expenditure, whether it is a capital expenditure or a revenue expenditure. The source or the manner of the payment would then be of no consequence. It is only in those cases where this test is of no avail that one may go to the test of fixed or circulating capital and consider whether the expenditure incurred was part of the fixed capital of the business or part of its circulating capital. Right? Fixed capital, your fixed assets, that's your fixed capital, machinery, right? If you're running a manufacturing plant. Circulating capital, right? It's part of your stock in trade. Basically, right? You keep churning it out, right? So, but you go to that test only when the test of enduring benefit, right? Only when the test of enduring benefit does not give you an answer, right? What is the test of enduring benefit? Again, very important, right? I'm going to repeat this, guys, and I'm taking things slow. I know I am, but I have to because it's tax law and it's not straightforward. The aim and object of the expenditure will determine the character of the expenditure, whether it is a capital expenditure or revenue expenditure. The source, the manner of the payment would then be of no consequence. It doesn't matter where you get the money from. If you are paying a listing fee, your initial outlay of that listing fee on the stock exchange is considered a capital expenditure. There is the test of enduring benefit there. Why? Because you want to raise money. You want your stocks publicly traded, right? You want your stocks publicly traded. You want to churn out a profit, essentially, right? You want to churn out a profit for the company, basically, right? It's as simple as that, right? So when you make that initial outlay, you're making it for the enduring benefit of that business, and that's a capital expenditure. However, when you keep paying that annual listing fee, that is revenue expenditure. Right? Where that money comes from is irrelevant, right? The test of enduring benefit there gives you a clear-cut answer. But if the test of enduring benefit does not give you a clear-cut answer, you go to the source of the money, okay? No court, right? No tax judge will accept your argument going straight. If you go straight to the source of the income and say, well, Your Honor, the source of the income is from the circulating capital, ergo, it's revenue expenditure. No, first that judge will want you to convince him that the test of enduring benefit does not give you a conclusive answer. The test of enduring benefit does not give you a conclusive answer. Then you go on to fixed capital or circulating capital. Then you go on to the source of payments, the source of the money, basically, the source of the expenditure, right? And when you go on there, let's say the test of enduring benefit has failed to give you a conclusive answer on whether it's revenue or capital expenditure, right? You have to apply this test, right? And I quote again from Assam Bengal Cement versus CIT. If it is part of the fixed capital of the business, it would be of the nature of capital expenditure. And if it was part of its circulating capital, it would be of the nature of revenue expenditure. One has therefore got to apply these criteria one after the other from the business point of view and come to the conclusion whether on a fair appreciation of the whole situation, the expenditure incurred in a particular case is of the nature of capital expenditure or revenue expenditure, in which latter event, right, only it would be a deductible allowance. Revenue expenditure deductible, capital expenditure not deductible, but yes, you can claim depreciation, okay, on a capital asset. Basically what you're looking at, me speaking to you, this video, right, the slides, this learning management system that has been designed on this website, all right, basically is a capital asset that has been created, right, for Sudhir Law Review, right? So I can claim depreciation, right, over a period of time on this software that has been created, right, for me by my web developer, basically, right? So it's a capital asset. So again, in business, always look at the creation of capital assets because you can claim depreciation. Let me give you another simple example of actually how companies can claim depreciation. There is something known as the OYCS scheme, Own Your Car scheme, that many companies run. My former employers ran that scheme too. What do they do under this scheme? They deduct a certain amount of money from your salary depending on the car you buy. So I decided to buy a Hyundai Accent car, basically, right? What did my former employers do? They deducted a certain sum of money, right, from my account, okay? Now, it is in the largesse of their heart that they decided to give me an interest-free loan for the purchase of the car. What does it do for my employer? What does it do for them? It creates an asset. That Hyundai Accent car was registered in their name till a few months ago, right? And when it is registered in their name, it is registered in the name of that business entity. Basically, what it does is it creates a capital asset for them. So it creates a capital asset for them, basically, and they claim depreciation. Depreciation essentially brings down your tax liability. It's as simple as that. So the more the employees buy a car, a company car as it's called, right, the more beneficial it is to the company because they can claim depreciation on it, okay? Now, on capital assets, basically you can claim depreciation, right? If it is a capital expenditure, right, you cannot claim a deduction, okay? A purchase of a capital asset used for the purpose of business is capital expenditure, right? Purchase of a capital asset used for the purpose of business is a capital expenditure. You can claim depreciation, but you cannot claim a deduction, a general deduction under Section 37, right? Your benefits are restricted to claiming depreciation, okay? Now, let me give you a few more illustrations of what is capital expenditure and what is revenue expenditure. Expenditure on raising loans for the purpose of the business is allowed as deduction. Since it is treated as revenue expenditure, you take out a loan, you say, okay, now tomorrow my business is struggling, people aren't buying my course packs, I say, well, let me take out a loan, basically, to make ends meet, right? That is allowed as a deduction. General deduction under 37, yes, it is treated as revenue expenditure. However, expenditure on raising equity shares or preference shares is not allowed as deduction since it is treated as capital expenditure. So what do I do tomorrow? I approach, a rainmaker or someone like that, and I say, you're running this website, My Law, you're doing a fabulous job, come take over Sudhir Law Review, okay? And I issue equity shares basically to them, right? I give them equity, right? Now that is also a manner of raising funds for the business. However, it is not allowed as a deduction since it is treated as capital expenditure, basically, right? So issuance of equity or preference shares is capital expenditure. Taking out a loan for the purpose of the business is allowed as a deduction as a revenue expenditure. Expenses incurred, again a beautiful illustration of the fine distinction between capital and revenue expenditure. Expenses incurred for registration of trademarks is revenue expenditure and deductible, whereas expenses associated with the creation of the trademark itself is capital expenditure and not deductible. right? You have created the trademark. You have created Sudhir Law Review is trademarked, let's say, right? I'm going to apply for the trademark as well. Sudhir Law Review is trademarked. All of the effort expended into creating that trademark, right, is not allowed as a deduction because it's capital expenditure. But then when I apply to the registry of trademarks and the expenses that are incurred for registration of trademarks, those expenses incurred essentially, right, are revenue expenditure, okay, post the creation of the trademark. Okay, so that is the concept of capital and revenue expenditure, and that is how it actually ties into the whole general deduction scheme under section 37. Remember again, capital asset, purchasing it is capital expenditure, no general deduction but depreciation. Revenue expenditure, yes, you get a general deduction under section 37.